I have to find it, but I want to show you guys this because this is the kind of research I do when I do full research on a company. I do research on its competitors as well. And I don't think I've shown you guys this because I haven't done this in a long time.
A lot of stuff.
Yes, so far it looks like I'm going to add about 100 to 150 new pages of content.
That's really a lot.
Okay, so this entire chart here, you guys see this, right? When I analyze a company and they have public company competitors, this is the kind of research I do not only into the company itself, so in this case Wendy's, but also to its competitors. So you see McDonald's here. And this isn't updated. This is from 2012. So this isn't updated. But the reason I do this, again, ROIC, ROE, I don't use really ROE anymore. I don't really use gross margin anymore, so these would be gone, but operating margin would still be there, ROIC, FCF sales, cash conversion cycle. Most of the rest of these would still be here. I want to do this amount of research because I want to make sure not only am I buying the best company, but if I do find another company through this research and through the relative valuations that's cheaper and more profitable and possibly better, I want to know that I'm potentially buying the best company, not just the one I'm researching. Does that make sense?
Yeah.
Okay. So this is something I've never showed you guys either. These two right here are metrics that I came up with. Well, this one, the total obligations and debt divided by EBIT, is a metric I came up with. To me, this shows how much obligations and debt a company has compared to its profitability. So the higher this number is, the worse or the more debt a company has relative to its profitability. So generally the worse that is, right? Correct? So you were talking about McDonald's. These are from 2005 numbers. Anything here catch your eye before we get to Wendy's and the asset reproduction valuation now?
The gross margin is the highest, one of the highest.
Anything else?
The return on invested capital is the highest. Cash conversion cycle, is that the one you're looking at?
Well, I'm looking at several things. This is insane.
Operating margin, 5-year average.
That's
27.
just absolutely nuts.
For a hamburger shop.
Well, for any, I mean, it's insanely high because you can see the average here for the entire industry, but that's overinflated because of this number. That's absolutely insane for any company. 27.4. I look for anything over 10% on a consistent basis.
I don't know the specific metric. When I did my research on McDonald's, they were transitioning from a company-led, from a company-owned business to a franchise model, and I think that's why the margins increased.
Why is that important? Why is that important in this fast food restaurant industry? Why is that important?
Well, franchises have higher margin but lower revenue.
Yes, so they earn a lot higher profits in terms of the percentage of profits, and their costs are a lot lower because essentially they offload, the McDonald's parent company offloads essentially the entire running of the company to the subsidiary company or the franchisee or whatever. They have to stick by their operations manual and stuff like that and their processes, but their margins are insane. So that's generally a good thing. Does it mean that they don't have as much control? Yes. But if their manuals and their systems are good, which obviously McDonald's are, then it doesn't.
Yeah, I had a friend who was looking to start a McDonald's franchise, and they don't give it to any Dick and Jane. You have to have like experience. You gotta have money. You can't borrow more than 50% debt or all the whole shitty requirement. It's not easy to start a McDonald's
Well, it's
franchise.
not. That's a good thing for them.
Not sure if it's the same in Italy. Matteo is. I don't
Yeah,
know.
I think here you need like more than $1 million to start one McDonald's.
Yeah, that sounds about right too. Through here.
You study to Hamburger University, that is their university.
You can barely hear you, Mateo.
You know?
Put the headphone on.
Yeah, you have like to study to Hamburger University.
Yeah.
I'm not joking. And actually, it's one of the it's one of the most difficult school to enter if you want to go straight to the Hamburger University, for example, to be a manager of McDonald's, maybe like country manager or manager of some region. It's one of the most difficult school to access because it's one of the best school of business. And so I remember that I was looking about that, and to open McDonald's, you need more than $1 million, maybe now even more. And you need to study to this university, and you have to be the manager of your own McDonald's.
Why?
So,
Why do they want you to be the own manager?
yeah, because otherwise, I mean, that's the best guarantee that you can give to them, to be there and manage your own company, your
Yep.
own small. It's like a small business, small restaurant. So, because even if you have the brand and everything else, all the support that McDonald's brand can give you, you still can fail if the food is not so well cooked. And it's a fast food, but still to cook the food in a fast way and still to have the same taste, it's not easy. I mean,
Yep. Perfect.
so it's so strange, and I think that many other business fail, like franchise business fail, because they just want to make money on the franchisee. Like the ultimate goal is not to make a great company, but just to make money on the franchisee.
Yep.
So, okay, pay me, I give you the license, and that's the
Perfect.
business.
So the next thing I notice here is this insane number.
Yeah.
Again, that's because their franchisee model, because their systems are so good, because the processes are so good, they make essentially double what the highest other competitor makes in terms of free cash flow.
Oh, that's crazy.
That's insane. I don't know if we've talked about the cash conversion cycle much. Do you guys know what these numbers mean just by looking at them right there?
It's like how much it takes for you to convert in cash what you sold, no?
Yes. So essentially this is how long it takes you to sell your inventory to customers, how long it takes to receive payments from those customers, and then how long it takes you to buy inventory with that cash you got from your customers to turn it into more inventory, and then you complete the cycle. Typically, the lower this is, the better. Do you know what it means when it's negative?
That you can't convert in cash?
No. So it's pretty rare when you see it's negative. Typically, this is reserved for companies, again, like fast food companies. You see their cash conversion cycles are really low. Amazon, Walmart, these kind of companies. What this means in a real world sense, when the cash conversion cycle is negative, is essentially the customer pays for the product or inventory or service or whatever before the company has to actually pay out any cash. So this is a great thing when you see this. So essentially, especially for, what is this, Chipotle? No, Yum Brands. So Yum Brands, What this means in a real world sense is they don't have to pay. They get paid on, let's say, day 0 from their customers for their product, inventory, service, whatever. And they don't have to pay out any cash for 36 days. That's what this means in a real world sense. Does that make sense?
Yeah.
This is an incredibly, incredibly important number that pretty much no one talks about. Frankly, I've never seen anyone else talk about the cash conversion cycle. To me, it's one of the most important metrics I look at. Ultra, ultra, ultra important. If the company produces hard assets, services, those kind of things. If it's like a tech company, like let's say Facebook, this number doesn't matter at all. But if the company has hard assets of any kind, and again, these are hamburgers and these are hard assets, essentially, this number is ultra important. Retailers, this number is ultra important for. Manufacturers, and on and on. Okay, anything else? Okay. What does this mean?
I'll just have you look at the share price return of Wendy for the last 2001, so the last 10 years. They've actually outperformed McDonald's.
Well, take it from 2012 too.
2011.
2011, 2012, and they're like a 4x since then.
Oh, okay. They've outperformed McDonald's.
Yeah. I can tell you why, because again, I've researched them extensively.
Well, okay.
Okay.
4x. Oh.
So before we get to that, though, remind me to do that to tell you why. But before we get to that, let's go to the asset reproduction valuation. So this number on this page is pretty much the only one that means anything for the asset reproduction valuation. What does that mean? What does that mean when compared to what we know about the asset reproduction valuation?
That's assuming you want to sell the entire business and how much money you can get back, right?
Sort of. What is, okay, let's step back a little bit. What is the asset reproduction valuation? What does it cover? Which financial statement does it go over?
Balance sheet.
Yes. And what does the balance sheet figure out? At the bottom, what does it figure out? What is shareholders' equity?
The equity.
Book value.
So book value, yeah.
So right here, essentially, just by looking at this number, the 7.05 price to book is essentially, that means that at Wendy's current share price, it's selling at 7 times its net book value. Does that make sense?
When you analyze it, it was trading at 0.9 times book value.
Yes.
So it's 7 times more expensive now. Is that what?
So why is that? When I evaluated Wendy's, like I said, in 2011, 2012 timeframe, there was a ton of negatives about it. They had an enormous amount of debt. Their operations weren't producing enough cash flow to support dividends, share buybacks, and operations. So they had to continue to issue debt just to keep operations alive. Plus, they were reimagining their restaurants, which essentially means they're renovating their entire restaurant. So their CapEx was insanely high. So what I essentially found when I evaluated them the first time is, I think I pegged their real world value at like $2.70 a share based on my evaluations. But I said in the article that I wouldn't buy them no matter what, because I didn't trust their managers to do what was in shareholders' best interest, because there was stupid related party transactions, like they could use the private company plane for, they weren't supposed to use it for personal uses, but it wasn't barred explicitly. Wendy's paid for security for the billionaire chairman, I think is what he was, of Wendy's, when he could easily pay for security for him and his family, those kind of things. So I didn't trust that managers had the best interests at heart. And what I said in the article is, unless they either change their strategy and operations completely or sell assets, they're going to have to continue to reissue debt or issue more and more debt just to sustain current operations. I also recommend that they stop the dividend as well to pay down some of the debt. So since then, I think, again, I pegged the value about $270 a share. I think their share price was around $450 a share. So it's about a 4 or 5x since then. So what happened?
Do you regret not buying?
No,
Jason?
not at all.
I'm gonna ask you.
Not at all. Why? Because we've talked about this quite a bit, especially with Shafiq. Why do you think I don't regret it at all?
You want to take a stab at this, Mateo?
It's a tough one too. I mean, because you have like your criteria to buy some stuff, you know?
Yes. Essentially, that's what it is. It did not meet my criteria. I did not trust management. And at that point in time, based on the information I had then, I made the best decision I could then with the information I had. So obviously, you can't see into the future. And I don't like to play the hindsight bias game where, oh, I should have bought this just because it went up to 4x or just because it's been up 4 or 5x since then.
It's the same thing that the Warren Buffett about Amazon or Microsoft.
Yeah.
He was like, yeah, maybe it was a mistake or a stupid mistake. You can call whatever you want, but it was the best decision at the time, at least for me, he was saying. Because if I start to buy company without knowing what I'm doing, sooner or later I will even catch the company that will go down 5-10 times. So
yeah,
it's just a matter of time. Instead, if you know what are you doing, at least you know what was your mistake or not.
Yes.
It becomes investing and less of a game, you know?
Yeah. And essentially that's what I was going to say is essentially if I was doing that and I played that game back and forth between all the companies I've owned, essentially you're just guessing at that point.
Yeah. You don't even to do research because.
Yeah, exactly. So.
Wow, this business is on fire.
Look at this. So their revenue has dropped significantly.
Yeah.
But their margins have gone up significantly since 2012.
And the net income has almost
net income exploded, earning per share exploded. They've been buying back more and more shares.
Why's the book value down?
Aha, good question. So let's go see. So this only goes back to 2014. But when I wrote the original article, they had an enormous amount of intangible assets and goodwill on their balance sheet that I thought was overvalued and that they would have to write down at some point. It's down, both are down a little bit since 2014, but I can almost guarantee since 2012, they wrote down these amounts significantly. What does that mean if they write down goodwill and intangible assets in a real world sense? What does that mean?
I'm guessing they overpaid for acquisition. They admit they overpaid for acquisition.
That's goodwill, yes. That essentially, yeah, goodwill is an accounting measure, I guess, or accounting term for the amount you paid in excess of a company's book value. Intangible assets are things like patents, trademarks, brand names, stuff like that, typically.
Yeah.
If you write either of these down, what does that mean for the actual company?
I mean, you are taking out, if you take that out from the total assets, it's a lot. It's almost 2,000 that you take out.
Keep
So
going.
the really book value, it's much less.
Yes, and book value is a
than
sort of a
what
proxy for the value of the entire company, correct?
Yeah.
At least on a balance sheet level.
At least, yeah, that's true. So it's almost half of what they declare.
So let's see if this is still true. So this is, let's just round up and say 2 billion. Okay, so 3,626 minus. Okay. Haha, it is still true. So when you take out goodwill and intangible assets
Mm-hmm.
from assets on the balance sheet to find book value, or what I'm essentially finding now is called net tangible book value. Have we talked about that before?
What is?
Net tangible book value?
I think so. I mean,
Okay.
But I think
Guess what it means.
Okay, so let me back up a little bit. So book value by itself is assets minus liabilities, whatever's left over is book value, correct?
Mm-hmm. Yeah.
Mhm.
Tangible book value is you subtract from the assets goodwill and intangible assets, because most of the time these don't hold any real world kind of economic value. Now, in this case, because Wendy's is a pretty big brand name in the United States, there's some value here. But what I'm trying to find, or what I'm going to show you, is something that you pretty much you'd never see, especially on a giant company, is when you subtract the goodwill and intangible assets from the assets section of the book value calculation, and then you subtract total liabilities. Book value, essentially in this case, again, tangible book value is negative. What does that mean? I know we haven't talked about this before. Just kind of think about it logically though. What you know about the balance sheet, if a company has negative equity value, negative book value, what does that mean?
Does it mean the company owns more than it's worth?
In a real world, yes, that's true. But in a real world sense, what does it mean?
I mean that if they have a negative tangible book value, it means that if they cannot sell the company, they cannot have like property, other stuff to sell to make money.
Yes.
On a level, I mean, they have to liquidate the company.
Yes. So just to elaborate on that, essentially what this means to me is this company's balance sheet is jacked up.
Yeah.
So when I look at a balance sheet, I want a margin of safety on the balance sheet. I want little to no debt, lots of cash, lots of hard assets that the company could sell if it needed to raise cash. Wendy's is the reverse. Wendy's, essentially, another way to put this is Wendy's balance sheet is a negative drag on the company's value. Does that make sense?
Like, I mean, you mean that they made up the numbers in some way?
Well, okay, let me rephrase. So if a company has negative tangible book value, thinking of as a whole business owner of the entire company, if we were to buy Wendy's right now today, we would pay, in terms of market value, about $4.5 billion. Probably more after fees, and so probably $5 billion, something like that. But if I were to go in there and say, hey, what are these goodwill and intangible assets? I don't care about those. I don't want those. Maybe some of the goodwill or maybe some of the intangible assets I'll pay for because it's trademarks, brand name, stuff like that. But I don't want any of the goodwill and I don't want most of the intangible assets. So I think I should pay $3.5 billion instead of $5 billion, because this is about a $1.6 billion negative on the balance sheet. Does that kind of thinking make sense?
Yeah, but you still have the abilities to pay.
Yes. So And that 3.5 billion is almost exactly equal to the liabilities.
Yeah, so it's worth zero at that point.
So essentially what you're paying for if you were to buy this whole entire company is you're paying just for the liabilities.
Yeah, so if you pay that amount for the company, you still have all the liabilities. So
Yes.
you are not getting any more any more value to your acquisition other than the brand. But with just the brand and all that debt, it's difficult to run a company. I mean,
Yes.
it's not easy. I mean, at least I mean, it depends how you will use that brand, but how much can be valued that brand, you know?
Yes.
Because
So
you have to pay back the debt, so it's like you're paying 7 billion if you pay 3.5 billion for that company.
yes, exactly. So to further illustrate that point, shareholders' equity is essentially book value, correct?
Yeah, no.
But again, this doesn't include, if we were to subtract the 2 billion in goodwill and intangible assets, this company essentially has a negative book value.
Oh, 1.5 billion.
Yeah, about 1.5 billion. So that's what I meant by the $1.5 billion drag on the company's value.
Okay, yeah, I understand that.
Does that make more sense now?
Yeah, it makes much more sense, yeah.
Okay, so this is all important. I want to make sure I don't see anything major on the cash flow statement before we go to the reproduction valuation. Yeah, no, we need to go over that later. Okay, so the quarterly. Okay. Okay, cash is 414 billion or 414 million. Receivables 111. You want mind reading off these numbers to me? It'd probably go quicker.
Like you go.
Okay.
Yeah, just go straight down here and say the number that's all the way over here to the right. So what's next after accounts receivable?
Okay. Hours.
Equity and other investments. What was this number? Do you guys have it up?
So is it total shareholder equity?
No, right here. On the equity and other investments, 285.
Different number. Do you have the Wendy Co. Class A? Is that the one?
Yeah. When is the ticker? WEN. Are you on annual or quarterly right here?
Oh, I'm on annual. Are you on quarterly?
Yes. You always want the most recent numbers when you're doing an asset reproduction valuation.
But that's only good for 3 months.
Yeah, no, the balance sheet, you just add up the numbers. It's not like the income statement or a cash flow statement.
Oh. Yeah, but isn't it every quarter?
What?
But if you put the statement type to every quarter, then you're gonna have like every 3 months.
I don't understand what you're saying.
Like, you know how if you split the statement type to quarterly for the balance sheet, then you're gonna separate the balance sheet into every 3 months.
No, because we only do this with the most recent numbers. We don't do this. Well, I mean, you can do it every quarter, but you just need to update your numbers every quarter. These don't add up to trailing 12 month. Like, see, there's no trailing 12 month over here, like on the income statement. This is just what the company has on hand, on hand as of this time.
Oh, right. Okay.
1, 2, 6, 4. Other long-term assets. This has gone up a lot in the last quarter. Just
What's the long-term asset?
depends. It's usually a catch-all. You have to go to the footnotes to see what's exactly in there. Okay, so I'm going to add this up first. Total assets, 5186. Okay, and here's where I need to make a little explanation, because when I first was doing this, I made a mistake. I forgot that you include the liabilities in this. When I first started doing the asset reproduction valuation years ago, I forgot that you're supposed to include liabilities, because liabilities are a real world expense. Again, as a total business owner, you want. When I used to stop right here when I did the asset reproduction valuation. But you have to include the liabilities, because again, we want to think as total business owners of the whole company, and we want to know what the liabilities are, correct?
To take the total liability, right?
Well, I keep going down. Just so I know what the liabilities are, but you don't discount the liabilities. You discount the assets because you can't always get full price for those if you want to sell them, which I'll get to in a second, but liabilities you're pretty much always going to have to pay.
So just take the total liability, right? 4.5 billion.
No, I go through the whole thing just so if I go back, I can see exactly what went into the thing. Because I save these sheets. Like, for example, not necessarily the ones I worked on with the first edition of How to Value Invest, but now I save everything. So if I do an asset reproduction valuation for a company I evaluated 4 or 5 years ago, I can go back and look at
Okay.
it. Sorry about the coughing and clearing on my throat.
Okay. Yeah, we'll read out the numbers for you if you want.
Yeah.
So what is it? We up to
Accounts payable.
Yeah. So the next one is taxes payable. Which I had at nothing for some reason. Double check that.
Yeah, it says 0 on my end.
And then it's accrued liability, which is 141. And then is other current liability. And then is 90. And that total current liability. Like that what you just wrote down is just
Okay, yeah,
The-
just
the
skip that. Go
total
to the
is-
long-term liabilities, please.
Okay. Long-term debt 2302. Then capital leases 1416. Then deferred tax liability 268. Other long-term liability is 235.
And total liabilities.
Total liability is 4545.
Okay. Anything catch your eye on the liability side of things?
Long-term debt, obviously. That's pretty obvious.
Long-term debt and capital leases. Long-term debt is pretty self-explanatory, but what are capital leases, do you guys think?
The rent? Huh?
It could be. I mean, it's, to me, or most of the time, it's capital leases are things, actually, yeah, rent would probably be on this. The equipment that they have to pay for, stuff like that they have to replace all the time or whatever, stuff like that. So most of their liabilities are on long-term debt and capital leases. What does that mean kind of in a real world sense? What does that mean? At least in terms of the health of the company's balance sheet.
So it's the same like how much money it costs to run the business.
Yeah, so it's a high capital intensive business, which is the capital leases, but what the long-term debt, that doesn't necessarily explain the long-term debt.
Long-term debt, borrowing. They're buying back shares, right? They fund the capital program somewhere.
Yes. So that still means they're obviously buying back shares, but they're still likely funding the buyback of shares, the dividend, the operations with debt. This also means, from a real world perspective, these two things, as a total business owner, this is what, $3.7 billion. Most of your capital is tied up in long-term debt and capital leases. These
This is the same for McDonald's.
These are things you have to pay over time. Have to, or you go out of business. Okay, so liabilities you keep the same. 53, 16, 0, 1, 90, 2, 6, 5, 4, 5, 4, 5. Okay, so let's go up here now. Mateo, I think we've done reproduction valuation before, right?
No, we did one time, but I missed now the part about the capital leases that you were talking about because my connection went off. I don't know.
Oh, okay. What I was saying about the capital leases is that as a total business owner, these are $3.7 billion in liabilities you essentially have to pay or you go out of business.
Ah, yeah, for sure.
And it's a massive drag on the company's operations and expense ratios as well.
Mm-hmm.
Because
McDonald's doesn't have capital leasing.
they probably either own their equipment already because they can buy at such scale that they don't have to pay over time for it, so they can just pay up front at a cheaper price. Also, some of it's probably because they don't own the land at a lot of these restaurants anymore.
McDonald's owns the land, right?
No, they own the land, but I think they lease it, so they might have it under. Yeah. I think they have it under a different. They might have it under different terminology.
Right. So there's different business model, right?
Yes. So McDonald's is actually more of a real estate company than a fast food company.
Where Wendy's more of a fast food company, right?
Yes, Wendy's is more of a fast food company that owns some of its real estate. McDonald's,
and McDonald's owns
valuations, and then the value of their real estate is
that's it.
astronomical. There's actually been talk for years that they should spin off their real estate into a REIT.
No, that's not gonna happen.
I don't think it should happen. That's one of the most valuable assets. Okay, so reproduction valuation. Me and Mateo did one of these a while ago, so I'll go over it pretty slowly. David, we haven't gone over this at all, right?
No.
Okay.
You take the cash at full value in the front.
Yeah, cash typically is at full value unless the company has a lot of cash overseas, or they have restricted cash that they have to use for marketing purposes or litigation or whatever. If typically this is 100% of the value though. Actually, let me back up. So what is a reproduction valuation? Do you guys know what we're doing here? What we're trying to find?
Yeah, I think you're trying to work out in the event of a liquidation. If you liquidate the company, how much money you would get?
Sort of. So this is a reproduction valuation. So there's a slight difference between a reproduction valuation and a liquidation valuation. Reproduction valuation, we're trying to figure out how much it would, or how much in assets and liabilities it would take to reproduce this company's operations. So Wendy's operation. Liquidation valuation is we're trying to figure out how much we can sell to get the company if we had to sell a bunch of assets. Now, those are the kind of main differences for most value investors. For me, the liquidation valuation and the reproduction valuation are almost the same because I'm so conservative in my estimates when it comes to reproduction valuation. But just know that if you see it from another value investor, there likely will be probably sometimes significant differences in the liquidation valuation and the reproduction valuation. Okay, so for accounts receivable, we can expect if we are having to do something we don't want to do, like sell the company. Again, liquidation valuation and reproduction valuation, I use pretty much interchangeably. So if we were to come under stress and we need to collect these accounts receivable, we could typically collect most of them if we're working with proper clients and stuff like that. So what I typically take from here is 85% of the value as the reproduction valuation. That makes sense? And I round up on all these numbers too. So they won't come out exactly correct because I round up or round down, whatever the case may be. So here's where things start to get a little bit more art than science. And these depend a lot on your guys' personal preferences. Again, I'm super conservative when it comes to these evaluations. So if a number is small like this compared to a $4.5 billion company, I just write it completely off. Typically, though, for inventories, I take about 50%, sometimes higher, sometimes lower, depending on the industry the company's in. If the company has assets or inventory that, like, for example, if it's in a teen girls retail market, like a clothing store at the shopping mall, and they have a ton of inventory, I would probably take only 25% of that, meaning I would discount it by 75% because teen girls' fashion needs and wants change constantly. Now, if this was somebody who's been around forever and they have things that products that people will need over a long time, then I would probably take about 65% of this. Does that make sense? Prepaid expenses, again, I usually take about 50%. Just again, because you don't know what you're going to be able to get from these kind of expenses or what you're going to be able to get back from these kind of expenses, if anything. So just for conservatism's sake. So PP&E, based on what I just said, what do you think I would do here?
85%.
85?
I'm
Why?
guessing. Because I think it's realistic. I mean, if you're gonna buy, if you're gonna sell a land, you should be getting most of the value of it. But then you're gonna factor in selling costs and stuff.
So what I actually do here, in most cases, is take 50% of the value.
50%.
So you are, again, in most cases, most people's reproduction liquidation valuations, they take anywhere between 60 and 80% of the PP&E. Just for conservatism's sake, I do about 50% for PP&E.
But what you base this decision on? Like historical data, or because you saw that in the past it worked while doing like this?
Frankly, I'm horrible at estimating things. So I want to be as conservative as possible. That's as simple as that.
Yeah.
I'm horrible at estimating things.
Mhm. Like everyone else in the end.
Yeah, true. What do you think I should do with equity and other investments? These are likely some kind of stock portfolio, maybe a bond portfolio, maybe investments in subsidiary companies. What do you think I should do here?
That's really difficult. I mean, I will take, I mean, equity and other investments. So that book value that I read, it's based on what they think it is their valuation. So I will take just 40%. I don't know, because I mean, they can make up the numbers in some way. I mean, not on purpose, but just maybe take the maximum range of valuation of some investment if it's not on the market. But even in that case, you don't know. I mean, it can be an investment in a public company, and you can take the value at the right now value as the right valuation of that company.
Good. Good.
I will discount a lot. I mean,
Yes. So actually what I do here is I take about 60% because, again, I have to trust managers that they're telling me the truth on these kind of numbers. So I assume they're telling the truth. So I take about 60% of this number.
It's not just about telling the truth. It's just even about like how they calculate that, you know?
Yeah, exactly. But yes, you are 100% correct that this is pretty much their guess at what these companies are worth. You're 100% right. What about goodwill? Knowing we've talked about goodwill before, what do you think I do with this number?
I will take almost zero. I don't know. It's
Big fat zero.
exactly it's zero.
What about intangible assets?
I don't know. I mean, in this case, they have a good brand, so I will just put some value for the brand, but like almost zero, but some value they have for the brand.
Yes, and typically, if a company doesn't have a large brand, doesn't have valuable trademarks, doesn't have valuable patents, I write this off to zero, just like goodwill. But because Wendy's is a large brand in the United States, I'd probably take 30% of this value.
Exactly. Yeah, that was my idea.
So 379. Other long-term assets. This is kind of like, how do I get this to go away? It's doing this every time I click now. I don't know how I did that. There we go. This is kind of like equity and other investments. Without looking at the footnotes, we don't know exactly what this is. So what would you do here without looking at the footnotes?
At least 50% discount.
At least 50, yeah.
And that's typically what I do. I do about 50% unless I know specifically that they're worth more or less after looking at the footnotes. And again, this is why I save everything, because if I go back and look at the footnotes and I see something like I should discount this 100%, I can easily adjust it. I don't have to redo the whole thing.
Of course, yeah. In the end, investing. It's not a science. It's all about this, no, about the brand and putting a value about everything that you see. So
now you add this number up to get the total assets in terms of our reproduction valuation. So that is quite a bit different from this number, correct?
Yeah, the debt same. It's the same, of course. So this company doesn't have so much value right now.
But there is a caveat, and we'll talk about that when we get to it. But when I do reproduction valuations, liquidation valuations, again, these numbers right here are almost always a lot less than this because, again, I'm so conservative in my estimates.
Well, all right, yeah.
So if you guys do them, they might be closer, but for me, I'm so conservative that they're usually way off, especially if the company has a lot of goodwill and intangible assets. So, and because you were correct, so total. What's going to happen here, fellas?
Well, so David, you took a small apartment there. David is not listening to me. He's doing some stuff.
Talking to his lady, probably.
What?
Talking to his girlfriend.
Talking to some lady? Yeah, probably. I hope so.
David. He muted us, I think.
Yeah, he's ignoring us. No, I was curious because Chiang Mai, it's famous for digital nomad. So I'm curious about that city. I want to visit that.
Yeah,
so
me too.
He's there, so I want at least some video from him, the apartment that he chose. I'm curious.
Well, he sent me a picture of some looked like beef and broccoli, or what we call in the United States beef and broccoli, and he said it was only $4 US, and this huge portion looked really good.
Yeah. Yeah, they say it's good, like good price and good place. So
see if this works.
Yeah, I just the only one that saw that is still. No, but it doesn't listen. It doesn't see us because you can see it's looking at the phone. I don't know.
I'll message him on Facebook.
Yeah, on WhatsApp. Maybe he's using WhatsApp. He saw us right now. He saw it.
How do you get negative?
Huh?
Sorry, I was my girlfriend.
Oh, I told you.
You see. So Jason was right.
Oh yeah, I get it now. But even so, even if it's negative, if you're buying this business, what does it mean if you're investing in this business?
That essentially, what does this mean right here? What do these two numbers mean right here? If you're buying the whole business, what does this mean?
Is it gonna cost you more than it's worth? You're buying up all the liability.
Not really. It kind of goes back to what we talked about earlier, is where it's a drag on the company. Essentially what this means to me is that the company's balance sheet, not only is it horrible, but it essentially brings zero value to the actual company. So essentially this company is valued, in my opinion, almost 100% on its brand and on its operations. The balance sheet holds almost no value for this company. Does that make sense? And again, as conservative value investors, we want the balance sheet not necessarily to add a ton of value, but at least to have a margin of safety. There's no margin of safety here with this balance sheet.
So it's gotten worse. So you're better off buying like 10 years ago.
Yes. This is a very straightforward valuation. But in all honesty, it doesn't make that much sense for a lot of companies anymore, because a lot of companies now are based on information, knowledge, consulting, brands, trademarks, these kind of things. So while I still do this valuation, I don't look at it. Well, I do it for several reasons. If I find a company is selling below its reproduction valuation, it's insanely undervalued because of how conservative my estimates are with the valuation. So the main reason I look for it is that it adds a margin of safety. Now, I don't look at the balance sheet, the reproduction valuation, as if a company is not selling underneath this valuation, it's not a buy, because this is such an ultra conservative valuation. Does that make sense? So while I still use this for every company I look at, but it's not as important as it used to be for me when I first started investing. I look at the operations more now for operating profit, free cash flow, those kind of things. This I look more for, again, extreme undervaluation, which you don't see right now unless the company is just absolutely terrible. So this will be a useful valuation, though, when the next recession comes. Because even if you just go through rapid fire and find like 20 companies that are selling below their reproduction valuation, and you buy like 1 or 2% of your portfolio in those companies, you're very likely to do well over time because the undervaluation is so massive. Again, some will probably go bankrupt. This is essentially going back to the Benjamin Graham NCAV situation back in the day, where he just bought like 20 or 30 or 50 NCAV stocks, and some went up, some went down, but overall he did very well because the undervaluation was so extreme.
When's the next recession, Jason?
When's the next one?
Next recession.
Oh, next recession? I've been saying a recession is going to happen for years, so I don't even care anymore. Yeah, I honestly, I don't know. It's sooner rather than later, but I don't know. Especially if they keep manipulating the market. So.
Well, the interest rate is dropping in Australia. They've dropped it recently. They're going to drop it this year as well. So that's going to keep the market afloat for a long time. Yeah,
the Fed Reserve here hasn't dropped rates in a while, but mortgage interest rates are going down again. Like I think 3 or 4 year low. So I don't understand what's happening right now.
Doesn't make sense anything.
No.
But actually, when everything doesn't make sense, happen the crisis, I think, in the long term.
Yes, and that's why I say the recession is sooner rather than later. I just don't know when it's going to happen.
Yeah, it can take still 2, 3 years, 4. It can. Yeah. But for sure, it will happen because it's everything so.
Insane.
Insane things. I mean, not just the valuation of the company, but, and it's just too long as bull market,
Yeah, it's the longest bull market I think ever.
Yeah.
10 or 11 years now, something like that.
Yeah.
What's your 2009?
Something like that. Yeah.
It's 10 years.
2009. So that's at least 10 years. Yeah. And what's the mortgage rate in America?
I think for a 30-year mortgage right now, it's back around 4% again.
What about the variable?
The
variable, I don't know. No, I don't know. It's probably like 5, but it varies obviously.
Actually, in Italy, the variable it's less.
I think it's less. To be honest, I don't pay attention to the variable.
Yeah, the variable is based right now, so it's like 1% less than the fixed one that is fixed. It's like
cheap.
I think that's how it is here too. Now that I think about it, the 15-year mortgage rate I think is like 2.5%, something insane.
Oh, what the hell? That's so cheap.
Yeah, it's insane.
In Italy, if you're buying the first home, it's less than 2%, the variable one.
That's crazy.
The fixed one is
pay
like
3.5.
30% for 30 years.
3.5 in Australia or in Malaysia?
Yeah, Australia.
What's in
So
Malaysia?
it's about Malaysia should be about the same.
That's insane.
How much it
That's
is?
fucking crazy.
About the same. He said 3.5%.
Yeah, so
3.5.
it's they are low everywhere, so it's strange, you know.
Yeah, it's really weird. I don't get it. Don't get it, but that's why I'm.
But
Yeah.
I used to be paying 7%. I remember like 10 years ago, I used to be paying about 7% on my mortgage.
Well, in the United States, I think it was in the 70s, interest rates were up like 10, 15%, which is just absolutely insane to think about. And now they're 2.5%, 4%, whatever.
Uh,
Yeah, I mean it's normal to see that at the beginning of I mean after a crisis
Yeah.
to keep the economy going, but after 10 years to still see that kind of interest is really strange.
Well, and another weird thing is for the first time ever in the history of the United States, there are more job vacancies than there are people looking for jobs in the United States.
how come?
My God. Oh
It's
my God.
insane. I don't
No,
understand.
Really? So
Yeah.
it's not the unemployed that is the problem is that people doesn't want the job that is
They either don't want the job or the jobs aren't paying them enough, quote unquote, to make them come out of not working.
Oh, yeah, okay. That makes
so
sense.
so you think that what the government give them it's more than the job, or I mean it's better than going to do the kind of job?
Well, in my opinion, whatever they're getting from unemployment combined with saving on childcare costs,
Yeah.
because childcare costs are just absolutely nuts in the United States, is not worth it to go work a job. Childcare costs.
I mean to work that kind of job. I mean, okay, I understand.
Yeah, I don't understand. I don't have a good answer for you guys. I'm not a macro guy in the first place, but I don't have a good answer for you guys. I love history. I don't understand what's going on right now when in the markets worldwide. It doesn't make much sense.
What would happen if a recession comes? What would happen to the mortgage rate? Would it go up or down or stay the same?
It would have to go back down again. You would think, but again, I don't know what's happening right now. It's just insane.
That's the problem. They will go back again, but I mean.
Well, and that's what a lot of economists are worried about in the United States. What happens in the next recession? You can't continue to drop interest rates forever. They're already near historic lows. So what happens in the next recession? Is it going to be worse than the last one because you can't lower interest rates like they did last time? It's crazy.
At least in Italy, I see that they are still building more and more homes because of this. Because I mean, low interest rates, so people can afford to have a home. So what will happen is that if we have a recession, all these they will not be able to continue to build this building that they are building right now because people maybe will lose their job or they will lose their savings. So, I mean, what they will do, all this company that they born just to as like building a home, you know?
Yeah, no, it's the same here and where I live in the Tampa area. They're just building homes like crazy.
Yeah, like crazy. It seems like the 2008. So
yeah. Speaking of, Matteo, did you ever put an offer in on that investment we looked at for you, that real estate?
Yeah, I did.
Did you get it?
I get the apartment that we look at with the same like interest rates that we talked, and it's 2% fixed for 30 years. With the down payment that I will do because it's more than a down payment. It's like I have to pay that money down as cash because why they are building the home.
Yeah. Okay. So it's like a deposit kind of.
Down payment. but it will work as that. I mean, I already talked with the bank, so when I will do the mortgage, they will. I will not need the down payment because I already paid half of the home in cash. So it's like the value of the home, it's already paid half of that value. You know, so
Awesome. So when do you get it?
in 2022.
Okay.
I will get in, but I mean the interest it will be like that, if not even more than 5%. It's what
Yeah.
we saw together, but maybe will be even more because I saw that. I mean, like having everything near, I can like even the metro that connects to the airport and all that things included, like the swimming pool, the spa, the sauna, the lounge bar. I mean, I can put even more than 100 euros per night, maybe even in a low season, because I have seen
That's
that
awesome.
in Milan, the Airbnb place, they go from like as low as 50 euro, but in some bad places, and to 200, 300 euros per night. So it depends, because Airbnb, I saw it's some kind of different. It's not just going to a home to like save on a hotel, but I'm seeing that it's a different kind of living the city. So
Yeah.
some people say, okay, let's go to a home because we are more like independent, you know, than in hotel. We live differently.
Yeah.
Like
That's
even
awesome. Good for you, buddy.
yeah, thank you. Thank you so much.
Did you ever decide what to do with, was it your grandfather's land or your dad's land too?
The land,
Yeah.
yeah, I decided to sell that because I mean it even costs to maintain that land,
Oh yeah.
because you for the government you can't just have the land like this. You have to at some point to like plant something. And even if I put the grain just with the government, I will make some money just because the government give me some money as support to
Yeah. Yeah.
plant the land. But I mean, in the end, it's not worth it. I don't know how much I will make, but it's so low that I didn't even calculate the interest. It's
Yeah.
pretty low. It's just a little bit more than the expense. So
Yeah. Not worth your time then.
yeah, it's not worth the time because actually the grain they plant a lot of grain in China. They can even take the grain from there, from Greece, from every other country in the Europe. We have a lot of country, and in Europe that they can plant the grain at much less like
Oh
money,
yeah.
and so it's really not worth it anymore. It's not like it was, I don't know, 40 years ago maybe, that
Yeah.
my parents were talking about. So I at least I hope to sell the land, because for now I didn't receive like the right offer for the land. I
What are you
want
trying to sell it for?
I want just like yeah, the right amount. What the market values the land right now,
Do
not
you know
more.
what that is about?
Yeah, it's about like 22,000 euro for one. What is in English? Hectare.
We use acres, but yeah, I'm familiar with the term hectare.
Yeah, if you understand what it is.
Awesome. Good for you, buddy.
Yeah, thank you, thank you.
Of course. Do you guys have any questions about asset reproduction valuation? Anything? It's pretty straightforward. It's just more depends
Now I
on your kind
remember
of
we did one time, so now I remember. And no, one question was like, you use this kind of, you do this kind of evaluation for every company you look at, or just for company where you think that the book value is more important? Like you look at company, you say, okay, for this company it's good to look at the book value too, or you do this for every company like a routine?
I do it for every company, just for a routine, and just so I get a different look. This gives me a slightly different look at the balance sheet.
Okay.
But again, if I go in looking at a company that I know this isn't going to matter, I don't really put that much stock in it when I'm doing the analysis. I just want to do it again, just mainly because it's habit and because I want this information if I need to look at it later.
Okay. So you will just put there like, okay.
Anything on your end, David? He's muted again.
I don't know what he's doing.
Are you muted?
Sorry, what?
Are you
Yeah,
muted?
sorry, my headphone.
Oh, I said, any questions on your end?
No, that's all good. Can you explain why the market pricing in Wendy at such a high multiple?
I cannot. It's the same reason everything has high valuations right now. It's just stuff. People keep buying stuff and driving up the prices. I don't have a better explanation for that. I mean, their margins are better, stuff like that. But other than that, your guess is as good as mine, to be honest with you.
I understood that the stock market, it's an action system.
Yeah.
Because when I was younger, I didn't understand that. So it was like, why some companies valued at so much valuation, and in the end they don't even make money. After when I understood that the stock market, it's an action system, I was like, okay, so it's like buying some, I don't know, some in an action system, you can pay how much you want. Even for a Picasso, you can pay $200 million, and it's a Picasso. You can value $200 million. You can even don't give a fuck about the Picasso, maybe.
Yeah.
So,
well, and to illustrate a great point, but to illustrate that point even further, David, your question was about the valuation. So here, I'm just going to do the EBIT valuation real quick that I always do. So 273 trailing 12 month operating income times 8 plus cash minus debt company has, according to my evaluation, is worth $273 million right now. Or
how much?
$273 million after subtracting debt.
$1 million, right?
Yes. Okay. And it's worth on the stock market $4.5 billion. So that further illustrates the point. I don't know what's going on in the market right now. I legitimately don't.
But so to do the valuation, what kind of valuation you use? Like temporary EBIT or the net assets?
For this kind of company, I would use the EBIT valuation. So I would peg a real world value of about what I would want to pay for it is $273 million. So there's no way in the world I would pay.
So what kind of valuation, the EBIT you use?
The operating income times 8.
Times 8 minus debt.
Plus cash minus short and long-term debt.
Okay. Yeah, the typical one that you
And
use.
actually, now that I think about it, it's even worse than that because that valuation doesn't include the capital leases. So this company actually has a negative intrinsic valuation based on my estimates.
Mm-hmm.
So, I have no idea.
It's trading at 31 times earning. That is insane. 31 times earning.
Well, even the operating profit, it's trading at, what is it again, 273?
What the? This is worth more than McDonald's.
So it's trading at about 22 times operating profit, which is nuts.
But McDonald's, which is a much more better quality business, only sells at 25 times earning. This business is obviously not as good as McDonald's. They're pricing it at 31 times earning. That makes no sense. Would you rather buy McDonald's?
Mm-hmm. I have no idea. Like I said, this is a perfect illustration of what we were just talking about. I have no idea what's happening right now. No idea.
Yeah.
I'm confused.
Yeah, I don't know what's going on in the market either, David, to be honest with you. I don't. But that's why I've been concentrating on other stuff, so I don't have to keep looking at companies, because I literally just drive myself insane.
Nice.
Yep.
Yeah, it's the same with the Aussie market. Stuff. The market rallied, especially with the interest rate going down.
Yeah,
It's pretty much.
yeah.
It's pretty much anything that isn't fucked up in the market is worth a lot now. I think they really value stability.
No, it really
I think
is.
that's looking. Like
It's because
Coca-Cola.
a big thing is because interest rates are so low, people are trying to get some kind of return, and that's why they're driving all these stock prices up, because they're not getting any in their savings accounts.
Yeah, when the interest rate it's we see as the safest thing to invest in will be higher, the people will sell stock to buy that. So
Yep. I don't get it. This for me, David, to be honest with you, I used to have that same face as you. I was like, this makes no sense whatsoever. And I used to try to think about it and make sense of it. But the market right now does not make sense. Logical sense, it doesn't. People say efficient market theory. We just showed that efficient market theory isn't true, because McDonald's is a far better company trading at a lower valuation than Wendy's, which is a far worse company.
Exactly. But in fact, I cannot understand how people can believe to the market efficiency theory, because
I don't get it either.
I mean, it's all about emotions. It's like the things that I was saying before. It's like about doing a Picasso, what is worth. I mean, okay, yeah, there is like a company as operation, as all these things, but actually people doesn't look at it, because as you can see, they don't look at that.
And the longer you're in this arena, the more, because when I first started, the people used to say that no one reads financial statements, and I used to not believe in that. I was like, these people at Goldman Sachs and JP Morgan have to read financial statements.
Yeah.
They don't. They don't.
It's true. It's true. Or sometimes they buy company like Uber that doesn't make money, but in the hope that someday they can figure out how to make money from nothing. And that can happen, but it's much more easily that will never happen.
It's like a lottery ticket.
Yeah, just the expense will go up and up. It's much easier than suddenly they will make money,
Yep. Agreed. So, all right. Anything else, guys?
Nothing. It's everything. I think that we will start the coaching in September. So when my first payment will come in, and I am happy for that, because we can restart with the coaching. And so I hope that you will be fine too.
Yes. I mean, unless one of these things comes up and I have to go over to Dubai for a short period of time.
No problem. I mean, for that we can.
Then otherwise I'm good. So.
Okay, perfect. Because I want to do like 3 times a week. I remember was good. But if you have if you are busy with something else, even just 1 time a week, I mean, we can see how to do. We can figure out.
Cool. Awesome. Excited to see you both again.
Yeah.
Are we happening next week or what?
How about whatever days work best for you guys? Just let me know in advance, and I can typically make the day work. So just as long as I know in advance, just let me know.
I hope for me it's good.
Keep it same time now, just for consistency.
Yeah, for me it's good Sunday, because tomorrow will work. So
okay, we'll keep it at Sunday at the same time, 9 a.m. my time, whatever time.
Yeah, it's good for me.
Okay, great, awesome.
All right, guys.
Okay, bye-bye.
See you soon.
So you took an apartment there? I want to ask that before. You took a small